Hello and welcome. Merry Christmas to everyone for joining us here at the Kingdom Focus Financial December 2025 edition of our Economic Update. We have myself, Derek Mauldin, Michael Smith, and Chuck Etzweiler with us today. Let's take it away.
Thanks, Derek. It's good to see you again. Although I see you a lot in the office. But Chuck, it's great to see you too. Merry
Thank
Christmas,
you, my
buddy.
friend. Same here. Merry Christmas to both of you. You got it.
And Merry Christmas to all of you that chose to tune in for this month's market update. We've got a lot of information to share here at year end as we look forward to the upcoming year. So we're going to dive right in and get going. I'm guessing most of you have a big smile on your face from what you've seen so far this year in 2025, and we're quickly coming to a close. And so we want to talk about that briefly, but we want to use this month to look forward to 2026 and share with you our expectations or our thoughts and what our theme or story is going to be for 2026 and how it impacts our portfolio. So buckle in, grab your hot chocolate, pause, grab your hot chocolate, some snacks. We're going to try to do this in 15 minutes for you this month. And Chuck, why don't you kick us off with what our theme is for this coming year?
I'd be more than happy to, Michael. And this year's acronym is the word wiser. And who wouldn't, Michael and Derek, want to have a greater amount of wisdom as we age? We hope that that comes with that process. Basically, if you look at the year 2026, we believe it's going to be a positive year, but probably more volatility and uncertainty. And I'm going to make that case. The W stands for Washington, D.C. We'll talk about we're in the second year of a president's term, the upcoming midterm elections, which stocks work, which don't historically. Interest rates, my goodness, we're going to have a new look Fed most likely in May as Jerome Powell probably steps down. He will not be renominated as chair. We could have as many as 3 new Fed officials. What does that bring, according to the markets, when the Fed has upheaval? We are, however, in a secular bull market. We want to make that case that we started in April of 2013. Historically, these last about 18 years. 2 mega trends, guys. We've talked about this over the last several years. Electrification and the reshoring of manufacturing back to the U.S. soil. This continues to be, we believe, the driver of prosperity in the U.S. I catch myself, Michael, saying as I get older that, slide 2 says, age is just a number, right? Well, there is some truth to that in the equity markets. October 12th of 2025, just several months ago, we actually, this cyclical bull market, which began October of 2022, reached the age of 3. Now you go back to 1974. There have been 5 other times that we have reached the age of 3. Here's the good news, guys. On average, they last about 6 years in length. So what we did on slide 3, we actually said which break down each of those 6 years. And on slide 3, you can see this kind of the fame picture paints 1,000 words, right? The stress here happens between kind of year 3 and 4. And that's what this slide says. We had a really good year 3. And however, as we transfer from year 3 to 4, there's an issue. And I think that's what slide 4 is going to say. We get a midterm election. Think about it, guys. Next November, we've got to go through all the rigmarole, right, of the advertising and the yelling back and forth between blue and red. If you think about this, gents, 435 House of Representatives seats are always up for bid in the midterm election. You got numerous senatorial and gubernatorial races that are up for bid. And that tends to put stress on the market. And as my highlighted piece says over there, that you almost always enter a bear market in a midterm election year. You can see the average is 19.4%. We went way back to the 60s. However, what does it say then? The S&P 500 has not declined in the 12 months following a midterm election since 1938. My goodness, that's a long, long time ago. So what are we telling our clients, our investors? Expect some volatility, maybe expect almost a 20% sell-off. But if we stick with the plan, history would suggest that patience is rewarded to those that do. If I go to the next
Yeah.
slide,
Hey,
guys.
Chuck, before you
Yeah,
jump to that next slide, I just
yeah, please. Yeah,
want to
certainly.
add into that a little bit, and because I know some of you are going to say, so how are you going to adjust our portfolios? What are you going to do for me if you expect that we might have a very volatile or topsy-turvy year? And I think the answer is we've already built that in, right? So if you've
Yes.
worked with us for some time, you have heard us talk about how there are times where volatility is normal. And so we plan that into our average return scenarios that we project and we prepare for folks. And we don't necessarily make knee jerk reactions when those come because we're expecting them. But what those opportunities do is give us a chance to take unique strategies and put them into play. And so we're going to talk a little bit about that as next year plays out. But just because we're expecting extra volatility, and the market doesn't like volatility, right? You've heard this from
Right.
us before, regular elections, interest rate changes, all those things that cause upheaval, the market tends to get a little bit words sometimes. So we think that's coming in 2026, but that also affords us some tremendous opportunities. And that is how we'll manage through it within our portfolios.
Michael, I love what you said, and that really takes us to the next slide here, my friend, slide 5. So what does work in the second year of a president's term, midterm election? It's the healthcare sector. And if you just step out of the box of the investment world and you ask yourself, well, why? Healthcare, probably as an issue, is the number one political football that's tossed to and fro, right? Both blue and red want to come up with policies that allow individuals, which is called affordable healthcare. We'll leave it at that. So what happens if you go back to 1973, you can see here that again, the average rate of return of the S&P 500 in a second year of president's term is 0.62, but healthcare, gents, is up 9.03. And you can see in the other years of a president's term, other than year one, it lags. So what are we going to do here? We believe that in just setting the table, right? You can see that President Trump, of course, leading the Republican Party, is cutting deals with large pharmaceutical companies to bring down the cost, certainly of those businesses. That wipes away litigation or regulation risk. Democratic Party is setting it up as well. So we would think this year is no different. So if you take the W in wiser, it certainly is Washington, D.C., but there is some good news here, guys, and healthcare is going to be one of our overweights. As we shift to the next on slide 6, it's the I, right? It's this interest rate policy that's obviously depicted through the Federal Reserve and the Federal Open Market Committee. There's a lot of consternation here. Why? Jerome Powell, who has served as that chair, his chairmanship is up in May. He's not going to be reappointed. He has the ability to stay on, but he's probably not going to. So here's the betting mark. Kevin Hassett, who right now serves as the head of the economic advisors on the staff of the president, most likely is going to be given that nod. You also have some troubles with Governor Cook, who is being litigated for some issues, personal issues. You could have that person no longer on the Fed. And of course, you have this seat that Stephen Moran has taken from former Governor Kugler. So 3 seats, guys, are going to be up for bid. Now, what does this new look Fed going to implement for policy? We don't know that, but slide 7 would suggest that Jerome Powell and previous Fed chairs, Ben Bernanke and Janet Yellen, all had kind of this 2% inflation target. It was easy to meet in the 2010s, but in a post-COVID world, with manufacturing coming back to the United States, we have a higher standard of living, we pay a higher wage, and of course, we have stricter regulation. That leads probably to not a 2% inflation rate. Right now it's 2.75. Let's say it ranges between 2.5 to 3. What this new Fed likely is going to do is they're going to make a range between 1.5 to 3. They'll get to the 3% terminal rate quicker. And what would that mean? It would mean that financial stocks, banks, mergers and acquisition companies, companies that are asset managers will all benefit from lower short-term rates. So the I in wiser would suggest an overweight in financials, just like the W would suggest an overweight in healthcare stocks. So as we move to the S, I think this is the really good news. And if somebody could take just a nugget of this, we've gone all the way back, literally 100 years to 1926. And we found that the stock market moves over the long term, which we're going to use this word secular. I know it's got dual meanings to it. It comes from the Latin word secular. But in essence, it says that at generational patterns, on average about 17 to 18 years, where you'll have a flat market like we did from 1966 to 82, from 2000 to 2013, where the market doesn't go anywhere from beginning to end, but it has V's or W's strung underneath it. We broke out in 2013 and we haven't looked back since. Now, what are historians going to call that? I don't know. We have it up there: AI, robotics, automation, Web 3.0, blockchain, whatever. We're in a secular bull market. Now, what's interesting is, guys, we've heard this discussion about a bubble. And I want to say this up front. This bull market will end at some point. Nobody knows when. Our team has suggested it's not today and it's not in the near term. When it will blow off, the price earnings ratio will hit a high that is unsustainable. And what ends up happening, and this is Jeremy Siegel's work, Wharton School of Business had his grad students go back to the 1800s. And what you see is bull markets begin on low price earnings ratios, but they end at elevated price earnings ratio. So this chart only goes to 2012, but it's really when we broke out of this pattern. So you can see the average lengths, 17 to 18 years. So we're in this secular bull market. We're in year 12. If history has anything to say about it, it possibly lasts another 6 years or so. And because of that, we're going to continue in an overweight position in equities versus bonds until the landscape changes.
Yeah, and I agree. And this is a great opportunity, Chuck. I'm going to segue here to all of my clients who favor one side of the political aisle or the other. This brings home the point of how little Democrats or Republicans or independents really impact stock market performance, and your political affiliation should not affect your ability to invest in how you manage your portfolio. Because when you look at these cycles, simple math tells you go through 3 or 4 presidents in the White House during these secular markets, right, that are there. And so please, I encourage you, set those aside, separate the politics from your investment management structure as we move into the next year. That's my Christmas gift to you, right? Is to encourage you to separate those things that may hinder you to allow you to achieve the full potential that we can in your portfolio. Because the Fed will outlast any president. Interest rate cycles outlast any president. And it's the same here. Whether you like the current structure or not, it will change, and your political structure will change more frequently than your market structure. Agree with that, Chuck?
I agree with it 100%. I'll add this to it. Michael said with much wisdom, right? As we move into our wiser theme. That was well said, my friend. Well, it takes us to the last 2 slides here, slides 10 and 11. What's interesting, Michael and Derek, is that we've repeated these 2 letters as we remember this year, 2025, which some people may be watching in the new year and will say last year, but 2025 was power. The E was electrification. The R was reshoring. And again, remember, he said these are mega trends. And I love what you just said, Michael, that supersede any political power that is in office. I want everyone to understand that. Here's number one. Artificial intelligence is no longer just the tech story. It's an electrification story. It's about the AI infrastructure in the build out across the grid. No better place, right, but central Pennsylvania. And now we just see it before our eyes, right? 3 Mile Island, which all of us went through, is now being recommissioned into a micro pro plant. You're seeing that also in Iowa. You're seeing it across the country. Why? Because the power that's going to be needed, electricity, to meet the demands of the automation revolution can't be done on the grid itself. And you're going to see money, and the smart money, I will call it, move after whatever it is that they can get, whether it's alternatives, whether it's fossil fuel, to make sure that this stays on track, meaning this automation revolution. And with that, guys, we'll get to the last slide here, the R. Actually, this is now 3 years in a row. If you remember 2024, our acronym was FOUR, F-O-U-R, R reshoring. This year, 2025, POWER, R reshoring, and now WISER, R reshoring. Again, this is undeniable. We only have one slide here, but I wish I could show what you said, Michael, about partisan politics. We went back and looked at the Biden administration and the 3 bills that were passed, $1.85 trillion coming from taxpayer money to incent businesses to reshore their manufacturing facilities back to the U.S. We've also had $3 trillion that have been announced from 120 companies. You can see their logos privately on top of that. So again, an undeniable mega trend. And we want to own these companies that are participating in bringing their factories back to the U.S. They skirt tariffs. They get in good graces with the administration. They hire employees and they move towards, I think what we're going to see is a new era in the United States, much like the 50s and 60s post-World War II, a manufacturing renaissance. So there it is, Michael, our WISER, if you will, acronym for this year. And I'm going to pass it back to you, my friend, to wrap it up.
And then that's perfect, Chuck. And hopefully that helps all of you understand what we're looking forward to for next year. But before we get to next year, now that you have some time to digest that, I do want to take a minute and talk about our story, right? So we've painted a picture of what next year looks like. It's a story. We're thankful that you're part of our story, but for this season and for the balance of the next several weeks, I hope that you take some time in your story to spend it with some family, friends, and make some great memories. But I would be remiss if I didn't thank you for being part of our story and take this opportunity to remind you of the great story. I wore this sweater today for a particular reason because over the years, my kids and grandkids have loved creating stories on this sweater of mine that I have, which is really kind of cool. And it's something they look forward to. And we live our lives through stories, but the greatest story that exists was when God sent his son to earth to redeem us, to live here with us, so that he could offer us the greatest present ever given, which is eternal life, if you accept and understand Jesus as your Savior. So as we go through this year, we're working with you on the earthly story, but I hope that you're building a heavenly story in your future. And as always, if you have any questions, either about your earthly story or how to develop your heavenly story, feel free to reach out to us. We're here to help you. We love chatting with you and talking with you. So feel free to give us a call at any time, and we'll be happy to answer your questions. Derek, anything you want to say and as a follow wrap up to this holiday season?
Merry Christmas, and don't forget to like and subscribe below. Click that button there so you can get updates every time we do one of these, and feel free to reach out if you have any questions.
Great. Thanks, everybody. Thanks for being here this month. Merry Christmas.